This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Stock market meltdown. The selling was intense. The Dow and S&P 500 suffer their worst day of the year. How concerned should you be about today's steep sell-off?
Strong foundation. Home sales rise again in July, but so do prices. And with a possible rate hike on the horizon, is the housing market at a turning point?
Waterworks, from pipe breaks to outdated dams. Our series, The Big Fix, looks at what's being done to modernize our aging water infrastructure. All that and more tonight on Nightly Business Report for Thursday, August 20th.
Good evening, everyone, and welcome. The selling today was serious. It intensified into the close, and the damage was ugly. Gains for the year gone. The S&P 500 now negative for 2015. About 25% of the constituents of that index and a third of all the Dow components now sit in bear market territory, meaning they've fallen 20% or more from their highs. By the close, the major averages all lost at least 2% of their value. The Dow Jones Industrial Average plummeted 358 points to 16,990, breaking below 17,000. The Nasdaq off 141, and the S&P 500 shed 43 points. As stocks fell, so did bond yields. The 10-year yield now hovering around 2%, its lowest in about 4 months. Now, much of the selling had to do with uncertainty over the timing of a rate hike by the Federal Reserve and over concerns about growth across the globe. Bob Bazzani at the New York Stock Exchange has more on the sell-off and what's worrying the markets.
Groundhog Day again. The same gloom and doom. Asia down again, Europe down again, U.S. stocks down again. Yet when I called around in the morning and asked for a specific reason the whole market was down 1 to 2 to 3%, I didn't get an answer. Traders continue to cite a vague sense of dread and unease that has permeated the markets for several weeks now. The dread and unease centers on, first, fear of a global growth slowdown, particularly in China and Brazil. Second, weakness in emerging market currencies, which could trigger a cascading series of economic problems overseas. Third, uncertainty over the Fed's intentions on raising rates. And finally, there's worries about the potential collateral damage from the commodity collapse we've seen. This concern over collateral damage is a real worry for traders. It ranges from concerns that high-yield funds will fall further to worries that traders will start selling better-performing sectors to cover their losses. Today's decline was pretty broad. 6 stocks declining for every 1 advancing on heavier than normal volume. Almost all sectors were down 1.5% to 2.5%. The Dow Industrials represented the declines well. Healthcare stocks like Merck, consumer names like Nike, healthcare names like United Health, and tech names like Cisco were all down 2 to 4%. For Nightly Business Report, I'm Bob Bassani at the New York Stock Exchange.
Oil prices bucked their recent trend, rising slightly today after falling to 6.5-year lows yesterday. At the settlement, West Texas Intermediate rose 34 cents to $41.14 a barrel. But as Jackie DeAngelis reports, today's rise is likely a temporary blip, a very temporary blip.
After hitting 6.5-year lows, it may appear like crude oil has found some support just above $40 a barrel. Is it for real or just a head fake? Yesterday's Fed minutes are a factor. They triggered weakness in the dollar that's expected to persist. A weaker dollar is supportive of oil. But also a hurricane brewing down south, headed towards the Gulf. It doesn't appear to be a threat at the moment, but these are the types of events that can rattle markets. Still, this week's Department of Energy report showed us that production is flatlining, not declining, and imports were up, leading to an inventory build. That's definitely still a bearish sign.
The reality is that there has been way too much oversupply, and there was too much excitement about the fact that the U.S. was starting to slow down, but we don't need it to slow down. We actually needed to drop production in order to bring us to some sort of balance.
And it's not just the U.S. Saudi Arabia continues to pump 10.4 million barrels a day in July. And Russia's dramatically weakened currency is helping it lower production costs. An executive at Russia's state-owned Gazprom saying Russian oil firms are weathering low prices and will continue to increase output even if Saudi Arabia drives prices lower.
So where do oil prices go from here, and will we see that 3 handle soon or ever? Traders think it's possible to see a temporary upside bounce before we get there. What's remarkable, though, is that analysts are saying once we go down into the 30s, we could stay there longer than they were previously thinking.
In the second quarter, markets got excited about the fact that rebalancing was happening. Demand was picking up, and that has indeed been the case. And supply was going to pull back in three buckets, right? OPEC, maybe, shale for sure, and non-OPEC, non-supply might see faster declines. But all of those supply sources are holding up. So it seems like this rebalancing process might be longer and more painful than thought.
So look out, that three handle may not be far off. For Nightly Business Report, I'm Jackie DeAngelis.
Gold prices also rose today to their highest level in 5 weeks. As equities fell, investors rushed into the metal looking for a safe haven. Gold prices also helped by an easing dollar following the minutes from the last Federal Reserve meeting. We told you about that yesterday. By the settlement, gold futures gained more than 2%. They now sit at about $11.53 an ounce.
So what the heck is going on in these markets? Why now, and what does it mean for your investments? We turn to our two market guests for their analysis tonight. Jeff Kleintop, Chief Global Investment Strategist with Charles Schwab, and Michael Jones, Chief Investment Officer and Chairman at Riverfront Investment Group. Gentlemen, welcome. Nice to have you here. Michael, thank you for joining us in studio. Pleasure to have you.
Great to be here.
I'll start with you. You think that the market's overreacting fundamentally to both what's been happening in China and also the lower oil prices that we just talked about. Why?
Absolutely. Well, first of all, the worst scenario that we could have had was that China would have stuck to the dollar peg and kept their monetary policy too tight for too long. That could have, given the very definite slowing in the Chinese economy, that could have started a deflationary spiral. So the fact that they released the dollar peg, that gives them a lot of flexibility to start lowering interest rates and stimulate their economy with monetary policy. Even more puzzling to me is why anyone that isn't in Texas or Russia or Saudi Arabia would be upset with a three handle on oil. Most people buy oil. They don't produce it.
Meaning other countries.
Most other countries and most consumers in the world. And so right now consumers are getting a tremendous added boost to their spending power as oil prices drop, as prices at the pump drop. That spending power is right now being used to pay down debt predominantly. Savings rates are rising because no one believes that low oil prices are going to last. With the analysis you just saw from the Citigroup analysts, which we concur with absolutely, we think this bear market in oil is going to be here a long time. The longer the bear market lasts, the more people will spend the extra money.
Jeff, why don't you react to what Michael just said, specifically on oil, but also address the question of whether what we're witnessing today in the market is the kind of spasm we saw back during the taper tantrum a couple of years ago, and whether it's long-lived or not.
Michael made some excellent points, and I agree, I'm in agree with all those points, and in particular around oil. Even emerging markets are more consumers than producers of oil in these days. Certainly there are some exceptions to that, but that's generally true. Today was a dramatic day for investors. But this has been the most widely anticipated return of volatility I can think of. We all knew when the Fed got closer to hiking interest rates, markets would begin to react in a more erratic fashion. That's what we're experiencing right now. What we're not seeing is a dramatic slowdown in global economic activity. You know, it's hard for individual investors to keep track of every economic statistic around the world as much as you on NBR try and help them with that. One of my favorite things to watch is the Citigroup Economic Surprise Index for the G10 countries. That's been rising over the last 3 months, which means data, on average, has been beating expectations. So we're not seeing a global slowdown that would justify a much deeper decline in the markets.
So for the individual investor who has a longer-term time horizon, Michael, is today something that they should just put aside and take the longer view and maybe look at some stocks that are out there that today saw 2 or 3% declines?
Absolutely. First of all, we should recognize that today was a bad day technically for the market. We broke through the 200-day moving average. That's going to take a little time to heal. So this pullback may extend a little bit further. We see really strong technical support about 1977 on the S&P, but we would absolutely consider that to be a very good buying opportunity. I'm going to echo something that Jeff said. Volatility has been well anticipated to be coming back to the market. Quantitative easing in the U.S. is over. When the Fed is printing $80–90 billion a month and using it to buy safe assets, that's a tailwind for the equity markets that kept volatility low for years.
Yeah,
that is over. And so with quantitative easing in the U.S. over, volatility is back in U.S. markets. And as long as the fundamentals remain strong, it's a buying opportunity.
Michael says be very cautious, Jeff, on energy, materials, those kinds of shares right now. Give me a sector that you like if someone wanted to put some money to work after today's sell-off.
You know, I think the financial sector looks attractive here, technology as well, particularly in Europe, where you're seeing earnings growth actually picking up over the last few months. Even as prices for stocks have come down, they're down about 8% over the last month or so. That means valuations are down. They're looking attractive. Tyler, you mentioned the taper tantrum back in 2013. This very much echoes that as the Fed was looking to end QE. And it may end the same way, which is stocks get volatile, pull back a little bit, have a bottom and rebound. Financial is one of the better performing sectors after that took place in 2013.
All right, gentlemen, thank you so much. Great discussion. Michael Jones with Riverfront Investment Group and Jeff Kleintop with Charles Schwab.
To the economy now, where the number of Americans seeking unemployment benefits rose ever so slightly last week. The Labor Department says that jobless claims climbed 4,000 to a seasonally adjusted 277,000. Despite the increase, the overall level is still consistent with an improving labor market. Separately, a measure of manufacturing activity in the Philadelphia area came in stronger than expected, suggesting that the sector's moderate expansion should continue.
Sales of existing homes rose to pre-recession levels, climbing for the third straight month. The National Association of Realtors reported a gain in sales of 2% in July, but along with the higher sales came higher prices. And with all the attention now on the Federal Reserve and interest rates, Diana Olick explains why the housing market could be at a turning point.
Really priced incredibly well for this market.
There is definitely demand for housing.
I think we're good.
So much demand that Bernadette and Randy Reed were afraid to put their suburban Dallas home on the market.
We're all set. I would find a house that I really liked, and I'd look again and it was gone. And so it was pretty disappointing because I kept thinking, well, I don't want to put my house on the market and then be homeless.
That fear from move-up buyers like the Reeds is exacerbating already tight supply, which in turn is pushing prices higher.
Let me show you the house real quick.
The median sale price nearly 6% higher in July, according to the realtors. That was finally enough to make the Reeds put their home on the market, hold this open house, and take a risk on finding another to buy.
All of a sudden, it even seemed like even from January to even April, it seemed like the price had gone up even higher. So thought, you know what, if we're going to do something, we need to do it now, because if we wait till next summer, it's going to go up again.
Here's some information on the house.
Higher prices are hitting first-time buyers especially hard. They made up just 28% of the market in July, far lower than their usual 40%.
The first-time buyers are getting frustrated, first in terms of affordability, prices rising just too fast in relation to people's income, and furthermore, the rents are rising twice as fast as people's income.
Realtors are saying their buyers are getting ever more concerned about affordability, and the possibility of higher interest rates only makes that worse. Or does it? Some argue that higher rates would be a result of a better economy and a feeling from the Fed that housing is finally out of the woods.
If rates are going up, you got to ask why. Is it for the right reason? And from our perspective, if there's a 25 basis point hike, will that derail demand for housing? Absolutely not.
The Reeds' home did sell quickly, and just to be safe,
we actually put a contract on 2 homes, make sure that if we lost out on one, we had another backup at that point.
They also increased their budget to seal a deal. For Nightly Business Report, I'm Diana Olick in Washington.
And the president of the San Francisco Federal Reserve issued a warning for the housing market today. In a speech, John Williams said that raising rates is an effective way to cool off the housing market, but that it could come at a cost if the broader economy isn't strong enough. However, he also believes that if the housing sector and the overall economy are both doing well, then a hike in rates may keep economic activity from getting too hot.
And in Greece, Prime Minister Alexis Tsipras is stepping down and calling for early elections. Tsipras made that move after losing some support from within his own party over that country's bailout program. In a televised address, he said he negotiated the best deal possible. Elections will most likely be held next month.
Still ahead, the billion-dollar pharma deal that's raising some eyebrows. Late today, Hewlett-Packard reported its final quarterly earnings as a single company. The tech giant will split into two on November 1. Tonight, HP posted a 13% drop in earnings. They came in at 88 cents a share. That was, however, 3 cents better than estimates. But the company also said full-year adjusted profit would be below estimates, citing weak PC sales. Revenues came in a bit light, marking the company's 15th revenue decline in the past 16 quarters. And the stock was volatile in after-hours trading. Bertha Coombs has more on the results and the one positive in HP's report.
The one positive takeaway from HP's results is that the faster growing enterprise sector was the best performer during the quarter. That's where we saw the revenues actually exceed expectations, even as the full company's revenues fell short for the third straight quarter. Enterprise revenues were stronger, so were its services, both stronger than analysts were looking for. So as the company prepares to split into two firms, the enterprise and the slower growing printing and hardware business, it appears that the enterprise business may be on track. Bertha Coombs, Nightly Business Report, New York.
We begin tonight's market focus with more late-day earnings. Cloud computing company Salesforce reported better than expected quarterly revenue and profit and raised its full-year revenue guidance. The company cited increased demand for its web-based sales and software. Shares rose initially in after-hours trading but fell during the regular session to $67.82. The retailer Gap reported a decline in second quarter profits because of weaker sales at its namesake store and Banana Republic stores. The company did, however, maintain its full-year guidance and saw sales rise at its Old Navy branded stores. Shares didn't move all that much in after-hours trading. During the regular session, the stock fell more than 1% to $33.66. Sears posting its first quarterly profit in more than 3 years. The company sold hundreds of millions of dollars in real estate throughout the second quarter, but it did see its sales continue to fall. Sears ending the day down over 1% to $22.97. And the clothing company Perry Ellis lost money in the quarter, but revenue came in stronger than analysts were expecting. The retailer saw its inventories drop and margins grow, and in turn, it has raised its full-year guidance. Shares surged more than 7% to $25.18.
Disney and Time Warner downgraded today by Bernstein to market perform, renewing concerns about the state of the television business. The analyst there said the way these companies are being valued has to change, along with the transformation that's happening within the media industry. Disney fell a big 6% to $100. It was the worst performing Dow stock today. Time Warner shares off 5%, and the rest of the sector was dragged down along with them. Madison Square Garden, meanwhile, owners of the New York Knicks and Rangers reported strong second quarter results. The company saw revenue growth in its entertainment group as well as a boost in its sports business. The company announced back in April its intention to split its media and sports brands into two separate entities. The stock fell today, though, along with the broader market, down 4% to $73.32. The drug maker Eli Lilly reports that its experimental diabetes drug performed well in a large trial. The company states that the drug cut the risk of heart attack, stroke, and death among patients. The announcement sent shares of the pharmaceutical giant up over 4% to $87.33. And PepsiCo feeling the heat after diet-conscious customers began voicing their displeasure with the recently reformulated Diet Pepsi online. Pepsi announced back in April that it was rejiggering the recipe to remove the sweetener aspartame and replace it with Splenda. Customers have apparently taken notice. PepsiCo shares fell about 1%. They finished at $97.98.
The Canadian drug maker Valeant is acquiring privately held Sprout Pharmaceuticals just days after Sprout became the first ever company to win FDA approval for a female libido pill. The price tag was $1 billion, and that is raising some eyebrows, sending shares of Valeant 6% lower in trading today. Meg Terrell looks at some of the questions surrounding this transaction.
It's been called the female Viagra, and today drug maker Valeant Pharmaceuticals made a bet it'll be a blockbuster.
The opportunity is quite large. You know, it's certainly in the hundreds of millions for us, but we're hopefully it's in the billions in terms of what this could do from a revenue standpoint.
Sprout Pharmaceuticals' Addie this week showed the third time is a charm when it cleared the FDA after 2 previous rejections. The drug is approved for female HSDD, or hypoactive sexual desire disorder, something Sprout says 1 in 10 women may have. But some wonder if the drug's market potential will be limited by its side effects and question the billion-dollar price tag. Safety concerns include low blood pressure and fainting, which can be exacerbated by alcohol. Some say that could pose problems for a medicine that's taken chronically. Women must take a pill every day in order for Addyi to work. That's one reason that female Viagra is a bit of a misnomer. Viagra is taken only when needed, working on blood flow, while Addyi affects brain chemicals. The drug's approval comes with controversy after an intense lobbying campaign claiming sexism at the FDA. Now questions abound about how Addyi will be marketed. Sprout says it won't run TV commercials about the drug for 18 months.
It's not uncommon to see companies make voluntary concessions not to engage in direct-to-consumer advertising for a period of time after an approval. And we see this more and more with primary care drugs, where the agency is concerned about a drug launch being too fast out of the gate, if you will, too many people using a drug right away.
Sprout says it'll focus its initial efforts on communicating with doctors and explaining to patients exactly what the drug should be prescribed for. As for insurance, that's the next question. Sprout Pharmaceutical CEO Cindy Whitehead says she doesn't anticipate a problem from insurers.
In conversations we have with them today, they're covering the Viagra-like drugs for men. So they cover them at about a tier 2 to tier 3 copay, and we expect parity coverage.
Addyi is expected to be available in the fourth quarter. For Nightly Business Report, I'm Meg Terrell.
Coming up, pipes burst, dams break, and it's all because of our aging water infrastructure. Tonight in our series, The Big Fix, a look at what's being done to make sure you get the water you need.
Two senators are urging Japanese airbag maker Takata to immediately recall all vehicles that use the company's airbags. Senators Richard Blumenthal and Edward Markey both say their call was prompted by an accident that involved a 2015 Volkswagen. Federal investigators have already launched a preliminary investigation into that accident and to see whether Takata's new airbags have the potential to send shrapnel flying when deployed, just like the older ones did.
Americans drove more miles in June than they ever have before. The Federal Highway Administration said there were nearly 4% more drivers on the road that month than a year ago, making it the fastest growth rate since January. Cheaper fuel, an improving economy, and summer holidays are some of the reasons why more people are getting behind the wheel.
All week, we've been looking at our nation's aging infrastructure and what's being done to improve it. Tonight, we focus on water. Something everyone needs, and it's a sector under pressure from leaky pipes and water main breaks to dams that are in poor shape. Jane Wells looks at some solutions as part of our week-long series, The Big Fix.
Boy, I tell you what, that pipe is really going here.
If the 20th century was about harnessing energy, the 21st is about managing water.
Clearly, the United States in general is way behind on infrastructure.
There are nearly 250,000 water main breaks every year, according to the American Water Works Association. 2 trillion gallons of drinkable water may be lost, in large part to leaks. Nowhere is that more visible and more concerning than California, where a drought means every drop counts.
Line up.
The solution? New pipes and a whole lot of money.
We're living right now in the development that people put in when they built this city. So it's now our turn to come in there and replace that, upgrade it, and make it last for the next 100 years of the city.
Currently, the department says it would take 300 years to replace all the pipes in the city. With investment, they hope to cut that time in half.
Then there's the time and money being spent to upgrade America's ports, where trade accounts for $1 in $3 of GDP.
Block 1, lane 5, water side.
Instead of one dock worker on one crane, in the future, one dock worker will work several cranes, tackling the #1 problem at America's ports, congestion. $500 million is being spent at the Trapac terminal in Los Angeles on sci-fi robotic cranes, which move 8 times more cargo in one shift. And the Port of Long Beach is spending $2 billion building a fully electric automatic terminal. But as America's ports dig deep, as important as they are to the economy, taxpayers may not want to pay. Finally, there's a dam problem. There are 84,000 dams in the U.S., and the American Society of Civil Engineers report card on U.S. infrastructure gives dams a D. Now the largest reservoir in the San Francisco Bay Area is getting a $500 million makeover to build a stronger dam to replace the 90-year-old original, located 1,500 feet from an active fault line.
I think we need to recognize that we inherited a lot of infrastructure from a previous generation, and it's our responsibility to maintain that and to see that future generations can share in that benefit.
All it takes is money. For Nightly Business Report, Jane Wells, Fremont, California.
Tomorrow, our series, The Big Fix, concludes with a look at what's being done to improve the state of our nation's bridges, of which 10% are considered structurally deficient.
On this volatile day on Wall Street, before we go, here's another look at today's sell-off. The major averages all lost at least 2% of their value. The Dow Jones Industrial Average plummeted 358 points to 16,990, breaking below 17,000. NASDAQ tumbled 141 points, and the S&P 500 shed 43. We'll see what tomorrow brings.
What a day it was. Stay tuned.
It really was, yes. That does it for Nightly Business Report. I'm Sue Herrera. Thanks for joining us.
And thanks from me as well. I'm Tyler Mathisen. Have a great evening, everyone. We'll see you back here tomorrow.